In the first of two appearances on Capitol Hill this week, Fed Chair Jay Powell warned that holding rates too high for too long could hurt economic growth. Let's bring in Lauren Goodwin, economist and chief market strategist at New York Life Investments. First of all, New York Life's a huge company that people, it's the biggest mutual, right? Mm-hmm. But the third biggest insurance company. Did you know that? It's big. So are you investing for clients' portfolios, or are you managing some of New York Life's investments to make sure that they can make good on all their insurance products?
New York Life Investments is the third-party asset manager of the insurance company, so we're external money.
So you're not obsessed with like getting a return in fixed income so that you can pay out whatever actuarial tables say for those people.
That's
not what
correct.
It is. Okay.
We do, of course, have insurance and pension clients, and we spend a lot of time with the insurance company thinking about things like long-term interest rates and the Fed, but that's their pile of money.
For example, what you are, in terms of asset allocation, mostly stocks?
No, in fact, we're not just looking across stocks and fixed income. We're a large fixed income manager, in part based on the sort of foundation of the insurance company.
What I mean, yeah.
But also public and private asset classes. So across private equity, private credit, that whole suite of opportunities.
But if I were to probe deeply into your strategy right now, would it be mostly fixed income or would it be equities?
Relative to, call it a 60,
everything.
Yeah, relative to a 60-40 benchmark, we've been taking gains out of equity and activating them in fixed income. Actually, high yield credit's one of our more high conviction ideas.
That's where I was going, because Jay Powell looks like he's counting April as the first inflation, the first friendly number. So he's got, I don't know, 3 or 4 under his belt already, and he's made a tangible shift to the other mandate that the Fed has, and that's employment. So I don't know why people wouldn't buy more, extend maturities or duration or something, or put more in fixed income. Right?
I agree with that perspective. I think that we should, or one of the things that we've been acting in our portfolios is moving from equity but also cash into fixed income, because this is the top in rates. And that's something that wasn't clear to the market, even if it was our view 3 months ago or in April when Chair Powell started counting. One of the nuances, perhaps, is that duration moving way out in the curve when the yield curve is still inverted isn't our favorite way to take risk. And so though we've been moving into shorter duration fixed income in the short end of the curve, we balance that with long duration fixed income in the municipal curve because it's not inverted, as a way to keep that overall duration benchmark of the portfolio closer to neutral.
So these are not all pension. So these are individuals that do pay taxes, many.
Well, in the long end of the municipal curve, you're typically looking at taxable municipal bonds, so things like infrastructure bonds, which is another reason why we like it, because if you think about some of the more sort of structural opportunities that are there in the marketplace, the more consistent investment, things like grid improvements, municipal infrastructure projects, that's where you find that long duration municipal exposure.
Does that parallel what you hold in your equity side in terms of, seeing that infrastructure is a story in the municipal area, and then saying, that's a story in the equity side as well?
Absolutely. In fact, we're seeing more and more clients, we're beginning to do this ourselves, treat infrastructure as a tranche of a benchmark portfolio on its own. So that includes infrastructure equity. We're also seeing, typically a private equity portfolio wouldn't have strong sector tilts for us, but we are seeing more infrastructure opportunities in the private equity space and in private placements, the direct fixed income environment.
Are you surprised at how successful it almost seems like the Fed is in? When they stay way too long at the party, they get an F, right? We know that. Are they getting like an A- now or something for orchestrating the increase and then maybe taking the foot off? I mean, it looks like they're orchestrating a soft landing.
We have been in a soft landing for 9 months. I think they're as surprised as the rest of us.
It's a miracle that it's going to work out in spite of the Fed usually screwing everything up.
Well, and it was my view 2 years ago when the Fed was in the early stages of its interest rate cycle that it was their express policy goal to cause a recession. They were so worried, and frankly, I think that might have been at the time the right idea. They were so worried about 9% inflation that They said, hey, let's crash the ship while the consumer and the corporate environments are healthy. We won't have a financial crisis as a result. Let's get inflation lower. I think they're as surprised as anybody that the economy has been as resilient as it is. But now they're in an environment where they've sort of landed the ship. Now, it's my perspective that a soft landing is just a step on the path to what's likely to be a more pronounced slowdown. But there is no doubt that the last 9 months have already been a soft landing.
And you think it's going to work? Inflation is coming down. He's right about that. We're not going to be stuck at 3% in the last mile. We're never going to get there. And you don't think we're going to go past neutral on unemployment? You don't think we're going to 6% unemployment?
I actually believe that we will see a mild recession. And the mildest recession in the post-war period saw an unemployment rate increase of 1.7%. That would get us to 5.1. I think 5.5 is reasonable for this cycle in terms of an investor expectation of how high the unemployment rate could go.
And I don't know, stock market every day, the S&P and NASDAQ hit fresh, new all-time record highs where they've never traded before in my lifetime. How many ways can I say it? No, but they do. Do you think are we set up for some type of pullback soon?
Look, the equity market, what would cause it, right? I think what we've typically seen in an environment like this
unemployment at 5.5%.
That's exactly right. So I don't expect that we see major concern for the equity market until jobless claims start durably rising or earnings expectations fall. And we just haven't seen that. I agree with much of the commentary that I see that economic growth is clearly slowing, earnings expectations aren't. There is a mismatch there. But there can be high valuations and a mismatch in expectations for a couple of quarters. And so that unemployment rate that the Fed is looking at more and more closely, one of the more sort of tactile indicators we can look at is jobless claims that come out every Thursday. Again, not a lot of movement on that yet, but that's one of the things we're watching for a selling signal.